Hello, thank you so much for choosing to work with the Socha Lending Group. This is Mike Socha, the president of the Socha Lending Group, and I just wanted to take a few minutes to make a short video to go over a loan estimate, what to expect next, and also to chat about which fees in here are going to be the same no matter which lender that you choose. So first of all, let me tell you a quick story here. It's either 2018 or 2019, I can't remember which year, there was a law that was passed, and that law is called TRID. And in that law, basically what it says is that there were some unscrupulous lenders in the past, and they would maybe say, oh, hey, we're going to be able to do your loan for no closing costs. It's going to be really low. It's going to be free. And so they put some things on here that were not true on the loan estimate. And then people got to the closing table, and then basically they felt between a rock and a hard place because they saw all these fees there on their closing disclosure. So they passed this law, best of intentions to try to make sure that that wouldn't happen again. And so now what it says is that for certain sections here on your very first loan estimate, that whatever's on here is the max that you can pay for when it comes down to it at the very end. If it is lower on your first loan estimate than what it actually turns out to be, then there's what's called a tolerance. And that tolerance, then, it needs to be paid by the lender, okay? This applies to certain sections of the loan estimate. So I want you guys to keep that in mind, because what a lot of lenders are doing now is in any of the sections on the loan estimate where it is okay for them to put just zeros, some lenders are just putting zeros just to try to win a deal. In the other sections where you have to put whatever it is, they're putting default fees, which is what you have to put, which is the max amount of fees that they can be. Otherwise, they would get the tolerance and have to pay for it themselves. Here at the Socha Lending Group, we don't want to play games, so what we normally do is we actually send out your very first loan estimate on the higher end, okay? The higher end. So we would rather you guys see this and know that this is the max that it could be. It is going to be higher than what your actual one is going to turn out to, but as we go through this and we actually get your fees in, your actual fees from things like the title company or your homeowner's insurance or any of those types of things, we will go in and we will update them to what they are. Okay, so let's get started here. So I just mocked up a very simple loan estimate. It's for first name example, last name test. The parents weren't too creative there. So I just kind of mocked this up. This is just an example. So please, for any rates, any of these fees, etc., again, this is just for example purpose, okay? So on this first page, just going over it, you can see that it has the sales price at $500,000. They're putting 5% down, so a $475,000 loan. Interest rate at 5.125%, which would make their principal and interest on this about $25.86. Okay, you scroll down here and it basically says years 1 to 10, years 11 to 30. This is private mortgage insurance related. So do you see right here where it says PMI, private mortgage insurance? After the 10th year, it automatically falls off. You can ask, depending upon what program that you're in, you can't ask the lender if property values or if you pay it down for them to be able to drop it earlier. But this is an automatic dropping based upon all the criteria that's in there. This section just goes over that property taxes, insurance, whether those things are included in this loan estimate, which they are. This one includes the property taxes, the homeowner's insurance, and then this $79 for the mortgage insurance. You can, in some cases, pay the taxes and the insurance on your own. There are a few caveats to that, so ask your loan officer if that is something that you are interested in. Okay. These next two things I'm going to skip for now because we're going to review them here in just a little bit. So this second page is where I really wanted to focus our attention to. Okay. So section A here, this one that says originator charge, and section J here, these are the two that you should focus on the most, okay? So these are the ones that can really, with some exceptions, but these are the ones that can really vary from lender to lender. Some other lenders sneak in here points. So if you see something in section A that says either mortgage broker fee or loan originator fee here, listed here under section A, that means that you're getting charged points. So it's not the end of the world. Sometimes points make sense, but that is something to look out for, because if you get a rate that seems too good to be true, and then you look here in section A, you're paying $6 grand, $7 grand, $10 grand, whatever it is for it, then that means that it probably was too good to be true because you're paying quite a bit of money to be able to get that rate. Okay, some other things here, a lot of lenders, in fact, most lenders have an underwriting fee. So there is a way, if you increase the rate just a little bit, you can put this into the rate. If that's something that you're interested in, if you don't want to have fees as much, but you're okay with a little bit higher rate, normally about 0.125% more, you can put this in and make this underwriting fee go away. Sometimes there's a processing fee here. And then, like I said, sometimes there are points that would show up here in section A. Some other companies have random things like a technology fee. We call them junk fees here. We don't have any of those, but you would also see them here in section A. Okay. I'm going to move on to section B, section C now, the services you cannot shop for and services that you can shop for. So anything that is here in services that you cannot shop for, these are the ones we have to be really careful about putting in here, because if we put it in too low here, we have to redisclose it to you that it's more. So let's say that we had to repull your credit and we only charge $42. It literally costs me $42 to pull your credit each time I get charged the fee. So I would need to basically redisclose you if I had to do it again, and now say it's okay, now it's $84 to be able to do it. Appraisal fee is something that is paid prior to closing. Normally we send you a link for you to pay on your credit card, and basically because you already paid it, it's not going to show up here in your total closing costs because it's already been paid, but we need to make sure that it's disclosed on here. Appraisal fees, basically, I would say at the low right now, they're in the 600s, somewhere up to about 850-ish as the norm. If you need a rush, and or if it's a complicated property, it might be a little bit more than that, but I put 775 in here just as example for this case. Okay, services you can shop for. Normally this is title stuff. So this is the title company. Whatever this is, I don't care if it's me, another lender, etc. Whatever this is going to be a pass-through if it's a purchase. So the title company is normally chosen by the seller. So whatever that title company is going to charge, we are going to get that back. Normally not before this goes out, because this goes out upon when you very first do it. So we're going to have to go get that from the title company, and whatever they are charging is going to go right here. It's going to be the same no matter which lender you use. For a refinance, basically we can go shopping, or you can go shopping for a title company to see if we can find something that is cheaper than another one. Okay, so that's section C. All right, let's look at this other side. So section E normally is what it is. These are the government fees, basically to record that you are now the owner, or that you have a new lien if you're doing a refi for the same owner. And then these are transfer taxes here, because the government's got to get a little bit of money for the taxes there too. In some states, there might be a couple other things here. Some other states have what are called stamps. So like Florida, Virginia come to mind. The county and the state have an extra tax that might go in here. Again, just like Section C, these are all just pass-throughs. So no matter which lender you use in Section E, it should be the same. Okay? Section F. So this is if you are going to be using escrows. So escrows are basically your taxes and your insurance here. If you want the lender to escrow, awesome. But what they really need to do is have a little bit of padding there. So what they do is they are responsible for paying both your taxes and your insurance later. So they want to have a little bit extra in there just in case next year either your taxes or insurance amount actually goes up. Because they will pay it, and then they'll have to go back to you. If they didn't have this padding, they'd have to go back to you and basically say, hey, we need some more money. So out of an overabundance of caution, they basically put some here in both F and G to be able to pad your account. Hazard insurance, normally what happens is that is your homeowner's insurance. It might also be your flood insurance as well, depending upon your state. And they put this in here. What they do is they get discounts normally for you having an annual premium. So they ask you to pay it for 1 full year. And then they basically chop that number up into 12 payments. And then they save it up for you in that little savings account called the escrow account. And that way, in 12 months from the date that you close, now it's due again. So guess what? They already have the money saved up in that little savings account, and they use that money to pay for your annual fee again. And then that way they're able to get you the annual discounts. That is what this hazard insurance number is. Prepaid interest, it is basically only the interest payment, not principal and interest, only the interest payment that is left for the number of days that are left in the month. So in this example, this person is going to close 3 days away. 1, 2, 3. So they're going to close here on 27th. So they still need to pay 28th, 29th, and 30th to be able to have the house. So it's just the interest payment for those 3 days, about $200. They are going to have this house now. They're closing on 6/27. So this covers them for the rest of June. They're going to skip July, and then August 1st would be their first payment in this example. Okay. Again, E, F, G, these things are not lender specific. Okay. These are going to be the same no matter who you choose. So C, D, E, F, G, all the same. Okay. Going to come over here to H. These are optional things. Okay. So you might want to get title insurance. Most people actually do. That protects you in case later there is a lien that is placed that you might not know and that the title company didn't find. Basically, this little insurance would protect you for a couple years there in case something pops up later. Most people do opt for this. And this last one is you might have a verification of employment. So your company that you work for might charge us something, $100, $150, to actually say whether or not you work there. If they do, and we get charged, we'll pass it on to you. If not, this would go away. Okay? So all these things added up here, that is what are your closing costs. Again, these are just estimates. We estimate a little bit on the higher side because we'd rather you have an expectation that it's going to be more than what it actually is. So that way when you get to the closing table, you're happy. Cool. All right. If you guys have any questions, please contact your loan officer, contact me, and we would be happy to go over it. Thanks so much for watching.